To excel as a short-term stock trader, you must learn how to scalp. In this video, Jeff Holden, head of trader development at S&B, reveals his scalping secrets in precise detail, arming you with a major edge over retail traders. Profitable scalping is all in the details. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005, and proud to have developed number 7 and even 8-figure per year traders. Watch, take notes, and learn from the head of trader development at S&B so you can grow your trading account.
The thing that I wanted to talk about ultimately was scalping, right? So scalping, as Bella said, I think when the market shifted in 2022, Bella and Steve were sitting there in every monthly meeting, and Carlton can attest to this, and any of the traders can attest to this, and they said, hey guys, you probably need to start learning to scalp. Like, it looks like a scalper's market. It looks like that's a skill we need to pick up. You know, this is coming out of 2020, 2021, when all of the money was made on 3-day swings or giant intraday moves or momentum trading, and they saw this, and it only took us about 3 or 4 months of them repeating the same thing over and over for the desk as a whole to realize we needed to get better at scalping. We couldn't keep going through that drawdown, getting frustrated, and missing out on the opportunities that we had. So as we were talking about what I was actually going to speak about with scalping, this new concept emerged. And it kind of plays into what Dr. Steenbarger was talking about previously, where a trade is just, sort of the price action that's around it. But there's a lot more that goes into every single trade. And so we wanted to make this discussion a little more about what goes into every scalp. Even a very simple trade starts with a general idea of you have to understand how to execute and the rules around execution. But more importantly, you want to understand the catalyst, the setup, before you get into the trade. So that's really what we're going to talk about today, and I'll try and be brief. So as Bella said, I'm fortunate enough to be in the position where I get to interview the people that we are looking to bring on the desk. Now, at first I was very excited about this role. I thought it was going to be a lot of fun, meet all these really excited people, talk to traders all the time, probably come up with something that was like really cool and meet people that are going to be the next big things. And then as we went through these interviews and as we kind of firmed up our desk a little bit more, we started setting our standards and seeing what our standards are. And one of the things that's really important to us is that every person that walks through our door or anybody that's in our community, we believe has the potential to be a 7- or 8-figure trader. We truly believe that everyone, like Dr. Steenbarger said, if you find the thing that you're very good at, you build some skill around that, you have the potential to be a 7- or 8-figure trader. But let's put that in context. How many 7- or 8-figure traders do you know? Anybody? 2? I mean, you can't talk about Twitter because like everybody's a 7- or 8-figure trader on Twitter. You know 3. Anybody for 4? You know 4. Anybody for 5? Okay, on our desk. So it's pretty unrealistic to think that everybody could be a 7- or 8-figure trader if the biggest number that anybody knows here is 5. On our desk, we have Shark, we have Swang, we have Raf, we have Dan G. We have traders like Carlton, right, who's our risk manager and still can put up a big number because he's working in a team. We have some of the traders you met last night. We have Max, who's well on his way. He's in his 7s, and he's well on his way to being 8. We have Molly, who's in the back of the room. We have Cam, who's in the back of the room. We could go on and on and on for the traders that are at 8, at 7, or well on their way. That makes my job a little more difficult because it sets a very, very high standard. This picture comes up because we've made some interesting hires, and we've had some traders that come in and immediately think or tell us that they know exactly how to get to that 7 or 8 figure mark. And one of my favorite stories was a trader that was 2 weeks into being live, and Carlton's already laughing about this, but he was 2 weeks into being live, and he really had cracked the code on trading. I mean, he knew exactly what he was going to do and how he was going to get to that 7 or 8 figure mark. And all he needed to do was identify the 2 strongest stocks on the day and buy the opening print with 50% of his buying power, and then identify the 2 weakest stocks on the day and short the opening print with 50% of his buying power. And the strong one would go up and the weak one would go down, and he would make tons and tons of money, right? Flawless strategy. For about 2 weeks, Carlton's morning routine would be at 9 o'clock, he'd sit down, 9:01, he would get up, 9:02, he would walk over to that trader's desk and tell him that he's done for the day. That strategy didn't quite work for that trader. He's no longer with us, but we got the opportunity to learn from him. We got the opportunity to learn from everybody. That's one thing that we do exceptionally well as a firm. We learn, but we get the opportunity to learn at scale. We have 50 traders on our desk. We have 200 people here today. We have 1,000 people in our trading community. We get to learn at scale. That's a really challenging thing to do. That's the importance of being a part of a community, is if you're learning by yourself, you're learning as one person. If you're with 2 other people, you're learning as 3. On the desk, we're 50. As a community, we're 1,000. That's an unbelievable amount of scale to be able to learn and set new standards and put processes in place. So when you see anything about SMB, it is about teams, it is about building, but it's really about coming together and creating new platforms for us to pull ideas forward. So anytime somebody doesn't make it, anytime somebody comes in and we think they have the opportunity, but they don't make it, to us, that's a big missed opportunity. It's a missed opportunity for somebody to be a 7-figure or an 8-figure trader. That's a giant miss. How many of the traders in the room have been in a trade and you've seen it setting up, right? You entered the size that you wanted to enter, it started to work in your favor, and then you exited your position before you had a real reason to sell? Raise your hand. I see some people in the back that didn't raise their hand, so either you're not a trader or Steve Spencer raised his hand. If you didn't raise your hand, either you're the next 7 or 8-figure trader that we didn't know about, or you're probably not really trading. That happens to everybody. That's a missed opportunity. Now imagine that at scale over the course of someone's trading career. We cannot miss on our desk. We cannot bring someone in, we cannot invest in people and miss. The opportunity cost for us as a firm is way, way too high. So when we run into that, when we miss, what do? Do we sit there and cry or say, well, you know what, that person wasn't going to make it, they weren't good anyway, we're really good, it's them, it's not us? No, we get to work. We study every person that makes it, we study every person that doesn't, but like Dr. Steenbarger said, we spend way more time studying the people that have the noticeable successes early, the standout successes early in their trader development. And that's how we build a new platform. That's how ultimately we get to share things with everybody in this community. So when we were studying those successes, when we were studying those traders, there were a couple things that absolutely stood out to us. And one thing was really interesting because it wasn't in who they were. They really could not be more different. But when we looked at what they were trading and specifically how they were trading those things, we started to identify these very, very, very specific patterns. And it was a little different than even people that were in the same name. The people that were really having success were trading things a little bit differently. You could have the exact same name on, you could be trading even the same general idea, but they were doing something a little differently. We built this platform internally that focused on opportunity selection. What does opportunity selection mean to us? It's kind of 3 parts. Catalyst is the first one. Dr. Steenbarger kind of already talked about that, right? So catalyst is anything fundamental, anything technical. It's any real reason for the hedge fund players that Dr. Steenbarger said we could pick off. It's a reason for them to be in the stock, right? If the stock's not really in play, it probably doesn't have enough participants to really give us edge. We're competing against market makers. We're competing against funds that we have no business competing about. But when we go in and we have the right catalyst, we at least have a place that we can start. Number 2 was setup. So we have catalyst and setup. Setup for us, it's any technical pattern. I have to read this thing now. A technical pattern that describes what is happening in the price action. That's a pretty vague definition, right? But when we break it down to the setups that we trade well as a desk, they're essentially listed right here. There are some variations, but this is a big number of those setups that we trade well. And again, catalyst, setup. Well, what do we do with that catalyst and setup? That's where we have a trade. When you have the combination of catalyst and setup and trade, you can take any of these trades. And in some catalysts and some setups, these trades will not have edge. This is the problem that we've run into as we've paired quants with traders. Is if you ask a trader, a quant, to backtest an idea that a trader trades, it's really tough to filter that out. If you take a mean reversion short swing on a stock that's just breaking out, what do you expect to have happen? I mean, I see some heads going like, I wouldn't do that. Like, that's exactly what it is you want to take the combination of catalyst and setup into a very specific trade. But that means you have to know what that trade is to begin with. You have to understand why that trade has edge to begin with. The catalyst and the setup are just checks in the favor of the trade. And they help us delineate the difference between A plus, A, and B. And in your playbook, if you're trading anything that's less than a B opportunity, Carlton's probably going to be over at your desk pretty quickly telling you to stop trading. Because if you don't keep that threshold high enough, your EV is not going in the right direction at all. So there we go. We're catalyst, setup, trade. To give everybody a head start and to kind of mirror what we do on the desk, what we've built with the Scalp radar, if everyone's okay, I'd like to showcase this entire process. It's one thing for us to sit there and say, this is what you do. It's something else entirely to actually walk you through this as if you guys were all interns on the desk and we were actually teaching you this. So we're going to do it in about 10 minutes. Usually it takes like an entire day, but we're going to walk through it very, very quickly. So we're going to take the Spencer scalp, which is not a scalp we've talked about probably in some meetings, like in the 11 a.m. we'll talk about it, but we haven't actually taught it. And we'll be teaching it moving forward. Real quick story about Steve and why it's called the Spencer scalp. So I got to sit next to Steve on the desk, and there was one time that I was trading, and it was like a intraday range that was built out on a really good in-play stock that was breaking above a level. And like I bought the intraday breakout, right? And like I bought it, and I thought instantly it was going to go. That's what happens on intraday breaks. And it just sat there. And like 10 minutes into that trade, the thing was just popping around, and I started to get that like shot clock in the back of my head, like this is not going to work. This is not going to work. Like what is happening? And Steve just casually goes, "Hey Jeff, what are you trading?" And I mentioned it, and I heard his fingers click to the ticker, and he looked at it, and he goes, "Oh, interesting." And I was like, "That doesn't give me any more information. Interesting is not helpful to me." And he goes, "Let me know in 8 minutes." And I was like, that was oddly specific, like 8 minutes. And so 8 minutes later, I was like, "Hey Steve, I'm still in this thing." And he goes, "Okay, in a couple minutes, I'll probably buy the breakout." And I was like thinking, I've been on this emotional roller coaster wondering if this trade's going to work or not for 18 minutes. And you're telling me in 2 minutes, you're just going to buy it. And I was like, there's no way this works. In my mind, I'm like, this guy, like, come on, really? 2 minutes later, it breaks out. He buys it. And I swear it was like he called Goldman Sachs and told him to start a buy program on the stock. Because it just went up, and like it went up one measured move, he sold a quarter. 2 measured moves, he sold half. 3 measured moves, he sold the entire thing. And he just gets up, didn't say anything at all, just gets up and walks away. And I was like, this was like a mic drop. Like, what are you doing? Like, this is unbelievable. And then he did it again, like, later. And finally, after the third time, I was like, I have to learn what he sees. And so he taught kind of the basic principles of this, and then it ultimately became the Spencer scalp. So the core principle here is you're trading a stock in play. You're trading a stock in play that breaks above an intraday level. Steve's point was what's happening on a stock in play that gets above an intraday level. It's not that it gets above a level. It's the way that it moves up into the level and gets above it. And you can see from the low that was put in all the way to the move above the level, the sustained, consistent buying pressure. And Steve's point was very interesting, which was how do funds stay involved in stocks? Say they have a ton to buy. Do they just buy it all in one go? No. Any buy program has this flux between passive and aggressive buying. And he had observed over his trading career, when he started, he talked about he and another trader would just sit after hours and look through charts. Look through charts for hours, day over day, week over week, month over month. And they would pick up on these little patterns that probably nobody else would see. So he had observed that kind of a little bit more aggressive buying would turn into passive buying. And if it held above that level for 20 minutes, that means the shorts were likely to not get paid. But then it also was likely that that buy program was still there just passively buying, and it would kick onto that active buying trade again. So once the 20 minutes is held above that level, you can then look for a breakout. So you could take the initial trade if you wanted to, but if it doesn't go, don't freak out. Just sit there and you have your stop in place. Well, what I loved about this trade and why we adopted it is it starts with core principles. So where would your stop be for this trade? Yes, exactly. Right below the range, right? A lot of times we just do 2 cents below the range. Where would your entry be on this trade? Thank you. Yes, as soon as you get a range break, right? You have your stop and your entry. This is one thing a lot of traders struggle with. How are you calculating your share size? No. I mean, you can do that, but based on the range. Yes, you can calculate your share size because you know where your stop is and you know where your entry is. So even before the entry is triggered, you can figure out exactly how many shares you should be buying. So if you get an A version of this setup, you're risking A risk. If you get a B version, you're risking B risk. You know that in advance. It slows down the entire process of making this trade. Because of Steve's observations, you could also pick up on the expected moves. So we talked about it, one measured move, right? Everybody know what a measured move is? Measure the low of the range to the high of the range, add it to the high of the range, that's one measured move. So you're not exiting anything until it gets to one measured move. And then you're exiting a quarter of your position. 2 measured moves, you're exiting half of your entire position. And then you kind of keep that trailer on to see if it goes to 3 measured moves. After your second, you move your stop up to break even. You can move it up even higher if you really want to. But the structure of this trade is what we've done with everything in scalping. This set the tone for us to slow everything down. How many times do you get in that trade? And we talked about it earlier. Everybody raise your hand. You got in and you sold way too early. A lot of times you sell way too early because you don't have the appropriate structure. You don't really know where you think it's going to go. You're just kind of like, oh man, I hope it goes there. But when you have the right structure, you can lean back on that. You can slow everything down. You have the right structure, you have the right size, and then we're going to talk about the combinations that give you the best probability. So this is an A version of this trade. Again, we have A plus, A, B. Usually on our desk, anything below a B you don't touch. An A version of this trade has a catalyst that has to be fundamental. We don't trade this trade as an A version on a technical breakout. Sorry, you just don't. There has to be a fundamental catalyst. There has to be something that is going to change the news, the expectations of earnings in the company. The setups that Steve likes the most is the day 2. He loves it when you have a really good catalyst on day 1 and the stock kind of goes nowhere. He talks about it between above S1 and below R1, or really what, S1 and S2 and R2 or something like that? Yeah, S2 and R2. And then on day 2, it gets above that level, holds that level. That's an even better pattern. That's why he likes the day 2 the most. You can also get a day 1 on a breakout of a higher time frame range, right? And then the trade is what everybody just learned. It's the Spencer scalp. This is the B version of this trade. They're very, very similar, right? But we're opening ourselves to more opportunities. We're just going to put less risk on in these opportunities than we would in an A trade. So it can be a fundamental or a technical. It could be that technical breakout. And you can always just flip the trade. So when we say breakout, it could also be a breakdown. It's the same thing. But an execution is exactly the same as well. The shorts tend to puke out a little faster, though, just so everybody knows. But we're adding, you can take this trade on a trending day in the market. Garrett's going to talk to you about identifying trending days. This is a great trade on a trending day in the market. You can also take this trade after a failed breakout, or in this case, if you're going long, a failed breakdown. So when something breaks below a level, gets back above a level on an intraday basis or a higher time frame basis, and then has this exact same pattern, that's a B version of this trade. It's the same trade. You're just allocating completely different risk to it. What was so interesting about when we went into this catalyst setup trade combination and we started structuring our trades appropriately was that exactly what Dr. Steenbarger said of you have to identify who you are beating in the market. We realized by structuring things from a catalyst setup trade perspective, we were actually just describing the way hedge funds and institutional funds were likely to behave. So just by doing catalyst setup trade, we could identify the highest probability ways in which they would behave that give us an edge. The thing that was so interesting for all the developing traders was it opened up the doors to them saying, yeah, that's not really my trade. Because if the participants that were in the stock on that day weren't acting in that way, we didn't have any edge whatsoever. And you need to be able to back away from things that you don't have edge in. That's just such an important part about being a trader. So through this platform, we've identified a way to capitalize on the edges that are present, a way to size appropriately, and then most importantly, we've identified a way to basically feel confident that you can just say no. We do all this in the Scalp Radar. We do all this in the Scalp Radar program. We built it for the incoming classes. And then, as Bella said, they liked it. So we made some modifications. And it's such a joy to be able to share that with everyone. You know, we think of SMB, it's obviously the desk, but it's really the community. And we learn so much from everyone. And we do think everyone on our desk is special. We think everyone that's in this community is special. Everybody here today is very special. And thank you very much. I think we have time for one question before we take a little break.
Jeff, when you looked at the chart where you're identifying the buying pressure, if you don't mind going back there and saying, identifying those pieces.
Of the buying pressure?
Yep.
So look at it off the low. And we probably should have put a higher time frame chart on there, but look at it off the low, right? So think about the psychology. We talked about the psychology of trapped shorts earlier, right? If you're short this on the first 5 candles in this chart, what are you thinking? Are you feeling pretty good or bad? Justin actually does an amazing job of this in the bar by bar work. If anybody's seen his videos, I learned so much from watching his videos because of thinking about the way these are happening. I am super guilty of looking at a chart and seeing what happened and not thinking about how it happened, and he's helped me slow down so much in thinking about how it happened. So think about how this entire thing played out, right? It looked like for a minute that this stock was going to break down, right? What did it do? It got above VWAP, which is that pinkish line, and then more importantly, it held what? What's the blue line? Anyone want to guess? 9 EMA. 9 EMA, yeah, 9 EMA. I use the 9. I think Justin uses the 8. Some other people use different ones. But basically, we're all within like 1 EMA of each other. So I don't think it's really an exact science. But look at the price action around that EMA. What's happening? It's riding the EMA. Yes, it is not able to get below there. So what's also not happening? It's not extending away from there either, right? So it's just riding that EMA. So you have an aggressive enough program that it's there, right? But something that's not chasing at that point. And then what happens after that? When it gets above, it holds, right? So it stops going down, and it's now holding above that level. If you're short this based on that little tiny blow-off, how good are you feeling after 1 minute? You're probably feeling pretty good at the first candle within that box. You're probably feeling pretty good, right? Stock blew off, it's going to turn lower. What about 5 minutes? Are you feeling as good? What about 10 minutes? Are you feeling as good? What's so beautiful is right at that 10:30 mark to 10:35, that's that last moment of hope for the shorts, right? It like looks like it's going to break down, and maybe they're going to get rewarded, but then what happens? That's where that change really starts. So for all of us that focus on reading the tape, which everybody on our desk, you have to learn to read the tape, because you'll identify that before the breakout actually happens. You'll identify that change on the tape. You'll recognize what's happening within the pattern. Your risk-reward changes, your trade changes.